Hello, this is Tim Congdon. I'm chairman of the Institute of International Monetary Research at the University of Buckingham. This presentation has been given in the middle of March 2020 as the global coronavirus pandemic causes panic among policymakers and indeed collapses in financial markets. My main theme is going to be that the policy response to the coronavirus could well cause an inflationary boom. It may seem surprising at the moment, but with all the talk about a recession, but I'm going to present the argument that this may well be what happens in the next 2 or 3 years. 3 starting points. First of all, we will get over the coronavirus. At some point it will be in the past. And my guess is that 2 years from now there'll be a vaccine, people will be living and working normally, and life will return to normality and so on. Secondly, the policy response is going to cause a sharp upturn in the growth of the quantity of money in most of the leading economies. And this will have the usual consequence of a boom, certainly a period of above-trend growth of demand and output, and probably inflation. And those are my 3 themes. I'm going to spend most of my time on the second of those, talking about the relationship between what's going on in terms of policy and money growth. Now, there's a lot of talk at the moment about this pandemic creating a situation like war. The challenge for government policy unprecedented in peacetime, and more like that civil servants and politicians face when they're in conducting a war. We have it in France, where the finance minister Bruno Le Maire talks about an economic financial war. We have it in the UK, where the Office for Budget Responsibility says that this is a time in which the British government mustn't be squeamish about debt. It must sort out this problem of, because this is like war. And in the United States, there's even been calls for the involvement of the US military in the response to the medical problem, because after all, the American army has got hospitals and doctors and so on. So again, this is like war. Well, let's just be clear that wars cause inflation. I'm only going to focus here on one country, which is the United States, but in all economies, in all countries, when there is the need to pay for a war, you get inflation. If you look at the American situation in the 20th century, of course, the 2 big wars were, leave Vietnam to one side, the 2 big wars were the First World War, 1917 to 18 in the American case, and then also 1941 to 45 in the Second World War. And you can see here that American inflation moved up to over 15, in some cases over 20% in those periods. So I'm not, if you think this is like war, and the policy response should be like war, let's just be clear what happened in the past. Okay. Now, why is it that war causes inflation? The explanation is that the government is spending more money. It's not prepared to raise taxes. Therefore, it has to borrow more. It borrows to some extent from the banking system. That creates new bank deposits, new money. There's faster growth of the quantity of money, and then you get inflation. Of course, in the extreme, governments may borrow from the central bank, printing of money. But that's usually, in most countries, it's in fact this process of the government borrowing from banks and creating new bank deposits and so on. What I'm going to show in the next few minutes is this is exactly what's going on at the moment in the United States. So those processes that we saw in wartime in the 20th century, we are seeing now again. And let me just go through some of these signs. Just a few weeks ago now, his initial response to the coronavirus, President Trump talked about an $8.3 billion package of extra medical expenditure. Then there were the clampdowns on flying, the borders, and so on. So obviously this isn't the fault of the airlines, as Trump himself says. So the airlines want some compensation. They want some grants. They want some loan guarantees. And in total, the figure being talked about is $50 billion. We've then had, very recently, in the Wall Street Journal, a proposal from Professor Furman of Harvard University that the American government sends out a check of $1,000 to every adult, another $500 for every child, and this be done in the very near future in order to boost spending power and help the economy at this difficult time. Given the American population, that means that the total cost of that would be getting on $300 billion. And in fact, the talk is of a package now of special measures totaling $1.2 trillion. $1.2 trillion. Now, the American budget deficit, federal deficit last year, approached $1 trillion, $1,000 billion. It was planned to be, in the current fiscal year, a bit more than that, about $1,020 billion. We've now got $1,200 billion on top of that. So we're heading towards a budget deficit of well over $2,000 billion. USA is an enormous economy, much larger than that, but a budget deficit would be 8% or so of national output. It's still peacetime, remember. This isn't actually war in the sense of fighting going on, but a deficit of 8% of GDP in the USA. This is the kind of deficit, however, that was seen in the Second World War and the First World War. It's an election year in America. No wonder there's talk of this type. No wonder President Trump is going along with it. He wants to get re-elected, and you don't get re-elected in these sort of circumstances by being a skinflint. What does this then mean for the growth of money, the topic on which I concentrate and of which I'm most known? Well, in our analysis last year, we mentioned that there had already been an acceleration in money growth, quite a large one, through the course of 2019. So at the end of the year, the growth of broad money, M3, was around about 8.5%, well above the figures seen previously in the 2010s. We forecast this would lead to strong asset markets and above trend growth in coming quarters, as in 2020. And until the coronavirus came along, that was a good forecast. The February employment numbers were strong. We're in a different world now. But we're talking about a budget deficit of 8% of GDP, over $2,000 billion. It seems to me inevitable that this is financed to a significant extent from the US banking system, to the extent, say, of, sake of argument, $800 billion. Some of this happened last year. That $800 billion is itself 4% of the quantity of money. I suggest that the growth of money in the USA in 2020 will be at least similar to last year, maybe even higher, maybe more like, say, 10%. In the past, this sort of number has been associated with boom and then inflation. Okay. What about money growth elsewhere? This is much more a matter of conjecture and varies from country to country, but roughly speaking, the growth of bank deposits depends on the growth of bank assets. And banks can grow their businesses either by lending to governments, the public sector, or lending to the private sector. And I'm going to talk first of all about lending to governments. What we're seeing in most countries is extremely casual talk about large budget deficits. Even in the Eurozone, where the Stability and Growth Pact, enforced effectively by Germany, has kept public finances towards a budget balance, towards budget surplus in the last few years. I'm going to concentrate, however, on the UK and just think about what's already announced in some government plans. Budget time 2019, it was expected that the government would issue about 30 billion, 29.4 billion, what's called short conventional stocks, typically are bought up by banks, British or foreign. This is the typical kind of short-term, potentially inflationary financing of the budget deficit that one sees when there's really a large budget deficit. This year, early March, 10 days or so ago now, the talk was of a figure, short conventional issuance of £51 billion, up by 20 billion on last year, reflected the increase in deficit that the Chancellor was envisaging. But we've just recently, the last few days, had an even more talk of fiscal expansion, government spending, government mustn't be squeamish about debt. It seems to be plausible that, in fact, the amount of short-dated gilts that will be issued in 2020, 2021 will be, say, £80 billion. That will, again, as in America, this increased government financing from the banks will raise money growth. One shouldn't get too hysterical about it, but I would think it's quite plausible that money growth might rise, say, from 4 or 5%, which is what it was last year, towards 7 or 8%, possibly even higher than that. What about borrowing from the private sector? Well, it's clear that with companies' cash flows being shattered by these events, obviously the cash flows of pubs and restaurants, airlines, travel companies, hotels have all been disrupted, and they've come to nothing in the last few weeks, and it's going to get worse as the government restrictions bite. So very understandably, in some sense, perhaps very sensibly, the government has said it's going to guarantee loans, so that the banks can be sure that if the private borrower doesn't repay, the government will repay. After all, it's the government that's stopping people going to pubs and restaurants and hotels. So what's happening is that companies are drawing down credit lines ahead of the possible closure of those credit lines if things get difficult. In America, Boeing has drawn down a £13 billion credit line that was just available if it needed. That adds 13 billion to banks' assets and 13 billion to banks' deposits. I've got here a quote from a European bank who says that they're aware of this going on. The banks then have to think about how to finance these loan drawdowns. If they have a problem, they go to the central bank. And the central banks around the globe are being very helpful. Not like 2008, 2009, where in Britain the Bank of England was very unhelpful. No, all around the world they're being very helpful. In the last few days you've had in Britain an estimate of the size of the loan guarantees that the government will offer of £330 billion to companies predominantly. Boris Johnson again brings in this talk about war. We must act like any wartime government and do whatever it takes to support our economy. Well, in fact, total lending by banks to British companies is in fact £400 billion. So the loan guarantees are practically the entire corporate sector. In France and Germany, there are similar figures have been, in Germany, the figure is 500 billion euros for the loan guarantees being made available to the corporate sector. In France, 330 billion euros. My verdict on all this is that the growth of lending to the private sector will be very similar to what it was last year. There won't be any contraction in lending to the private sector, and therefore, if we combine the fact that budget deficits are moving out, the need for government borrowing from banks is increasing, lending to the private sector carries on as before, the overall message is faster growth of the quantity of money in most of the advanced economies in 2020 because of what's happening from the coronavirus. In other words, what we've got here is exactly those same processes that we saw that motivated the inflation after the First World War and after the Second World War, not on a smaller scale, happily, but they're still there. And my further message from all this, and to finish off the talk, what's going to happen over the next year or two as all of these developments work their way through the economy? I take it, as I said, that at some point, probably some point next year, the coronavirus will be under control and not dominating the headlines as it is at the moment. The extra money created by the policy response to these events will, however, still be there. So you're going to have a situation where governments have got still large budget deficits. Companies, households, financial institutions are going to have higher than normal money balances. And this will typically generate strong asset markets. I know it sounds strange at the moment, but strong asset markets, above trend growth in demand and output, and inflation. Can I just finish by saying that to some extent what's going on here is a misperception. Yeah, we have falls in output at the moment, and if you wish to use the word recession, that's fair enough. But this is not a normal recession. Normally, recessions are due to lack of demand. In this case, there's a massive supply-side disruption. Obviously, there's lockdowns, there's self-isolations, there are disruptions to supplies, components not coming in on time, and all that kind of stuff. And also major changes to the pattern of supply as we make more respirators and ventilators and protective medical clothing and so on. This is not a recession due to lack of demand. It's a supply disruption. And if policymakers react to a policy, a supply disruption by this kind of pumping up of extra demand with larger budget deficits and monetary financing of the deficits, the result, on all historical precedent, will be inflation. Thank you.